Welcome back to another episode of Investing Explained. Here's today's question.
I really like this question, and I have an opinion on it. I don't know if this opinion's valid, and the example that I'm about to tell you might be way oversimplifying things, but this is how I understand it. If you've ever played a game of Monopoly, what happens as the game continues to progress? If you start off with 4 players, you start off with 6 players or whatever. As the game continues to go on, there's domination and capitalization. There's domination that occurs whenever you're dealing with free markets, and there's winners and there's losers. If you allow that game to continue to go on and you allow businesses to fail and you allow other players to basically take possession of those assets, you have what's called consolidation. Now, imagine playing that game, but the banker isn't allowing other businesses to fail. Instead, what they're doing is they continue, the person who's playing the bank in the game continues to add liquidity into the game by adding more money. So a player's getting ready to fail. The bank steps in and says, don't fail. Let's give you another $100. And so you keep feeding liquidity into the game. Those players are going to be able to continue to play, but their chance of winning continues to go down and becomes less and less probable because that money continues to flow to the asset holders, the main asset holders in the game. And so, yeah, you can keep the number of businesses in there, but they become weaker and weaker and weaker, and the ones that are amassing all the wealth are becoming stronger and stronger and stronger. I believe that's an example of what we're seeing in modern economies right now. And the central bankers, through quantitative easing, and Japan was the first one to start doing this back in the 1990s. During this last credit cycle, you're now seeing it occur in Europe and the United States. And I think as we go into yet another credit cycle, whenever that happens, I think things are going to get really, really interesting because you're getting to a point where they've manipulated the financial markets so much that interest rates are pushed to zero. We even saw Japan during this last credit cycle push their interest rates into the negative territory. If you're talking about real rates, which are inflation adjusted, they're negative all over the place, depending on what duration you're talking. I think that is a major issue, and I think that one of the results that you're seeing out of that is the consolidation of what you just described. That's my personal opinion, and I might be really biased or have gaps in my thinking, but that's the way I see it.
I really like this question too. I don't think we ever covered anything remotely connected to this, so that's a really interesting point that you have. Whenever I look at some of the stats here, I think there are quite a few reasons why you're seeing this 50% shrinkage sense. I think right now we have around 3,600 listed companies, and it used to be double that just before the dot-com burst. There are quite a few reasons. IPOs, they're no longer as popular for venture capital as they have been. Back in 1980s, we were upwards around 80% of the IPOs that came from the venture capital background. Last year, it was only 15%. There's also this tendency that you will keep your company private longer if you can. Facebook would be an example. It was just massive whenever it was listed. You see more and more consolidation just in general. That was also what Preston was getting at before. That's easily a few hundred companies here over the past decade. Those are some of the reasons why you see this decline. When I think about it, I have a few arguments why it's not a problem. It's not a problem in the sense that when it comes to disruption, that growth typically comes from new businesses. We will still have startup companies, even though we didn't have listed markets or we didn't have as developed public markets as we have today. Also, a lot of the companies that are disappearing here on the exchanges, they're nano and micro cap, and most money are poured into the major indexes anyway. So I guess for most stock investors, it's not necessarily a big deal. There are also quite a few reasons why it could be a problem. One thing that is evident is that the fewer players you have in the market, the higher prices you will get. So for you as a consumer, it's probably not a good thing. One example that comes to mind would be something like the airline industry. The more consolidation you have seen here over the past 10, 15, 20 years, I think for frequent travelers, you will have experienced that it's been more expensive, not just inflation, but it is actually more expensive than it has been. There's another concern that private companies, they're not forced to disclose as much information as public companies. So that could also if that's the side of things you're on, be a problem. And the more power you have to companies, again, like what's the reason for the existence of a company? That is to make money. And profit is really what you as a company focus more on than everything else, for at least for most companies. So you will have more powerful companies, perhaps also more powerful companies than nation states. Again, depending on which side of the fence you're on, that could also be a problem for this. Really insightful question. I think this is a tendency, or I think this is a trend that very few people are actually aware of, and it can change the business landscape and perhaps also the political landscape, perhaps even democracy to some extent. So it's a very interesting topic that you bring up. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.